unaware of. And so for today and on Monday, we're going to do kind of a two-part series here on some specific examples of risks versus dangers. So for everybody who's new and for all of our live YouTube streamers out there, we do this Monday, Thursday, and Friday at 4 p.m. Eastern Time. So again, this is going to be part one, and then on Monday we'll cover part two. So get this out of the way there. Risk versus dangers. This is something that we do quite a bit of in financial engineering because, as I mentioned yesterday, to really get good at options trading and to use options in their fullest capacity and really what they were designed for, you have to understand how to break positions down synthetically. You have to understand that a long call could really be seen as a series of vertical spreads, as we're going to find out here in a little bit. Or butterflies could be seen as two facing vertical spreads, or maybe a short straddle and a long strangle. And the more ways you have to view these positions, the more choices you will have to potentially trade in and out of them profitably. So that's kind of the related topic. And for risks and dangers, all right, so these are two different terms. Most people would say that they're just synonyms for each other. And in a way, you could make that argument and say that it's a play on words, but in the world of trading, there are definitely two distinct topics, and you've got to be aware of these in order to make the best of your positions. So what are we talking about with risk versus danger? Well, let's start with dangers. What is a danger? A danger is a position that can only expose you to a loss. Now, of course, nobody would intentionally step into a trade like that, but what happens is that you might put on a vertical spread, and it's now moved in your favor, and it's getting closer to that maximum gain, or maybe even is at maximum gain. That's a very simple example of a danger. At that point, it can no longer help you. That's why it's called the maximum gain. And once it gets there, what's the purpose of holding it? You might as well close it out. Now, of course, most traders would see that as being fairly obvious if they're trading a vertical spread. But as I mentioned, what makes dangers so dangerous is that they can be in some very obscure places. They can hide in places you'd never think to look. So the idea here of a danger is that you end up accepting risk for absolutely no reward, or possibly just very little. Just makes no sense to do that. Now, if you discover that you have a danger, what you want to do is to eliminate it. And what I find that a lot of traders try to do is to manage it. There's nothing to manage. Or they think that they are managing some other risks and not recognizing that a super easy way to get to the bottom line is to just eliminate the dangers. But because they never see them, they never think to look there. All right, so that's another main point, is that dangers are often hidden. So let's take a look at a specific example with a vertical spread. Let's say that you buy the $100 call and you sell a 105. All right, so we got a 5-point, this is a debit spread and a bull spread. Let's say it's a debit of 3. And therefore, we would have a max gain of 2. So if you're new to verticals, you might not know that the difference in these strikes right here, 5 points, is the maximum that the spread could ever be worth. So in this case, the most it could ever be worth is 5. But if we paid 3 for it, then the maximum we could ever earn, what would land in our pocket as a profit, would be 2. And this is what the risk graph would look like. So we've got our bend here at 100, that's the long. And right here in the blue, this bend is the short 105. The red curve is what's called the current curve, and that's showing us our profits and losses today. So let's say that the red curve represents 30 days from now. That's the expiration date. The red curve is today. So the blue curve, you could also think of it, has 0 time until expiration remaining on it, whereas the red curve has 30 days to go. But we read them in the same way. And so if you notice over to the right here, if the stock moves up, this is our area of reward. It's our area of potential gains. And what if the stock moves down? Well, this becomes our area of risk, or areas of potential losses. And that's why I said in this case, it is a bull spread. It makes money if the stock price rises. All right, well, again, that's all pretty easy, but what would happen if the stock is up here? Maybe it's trading up around 120. Now, again, this is the 100, 105 vertical, but the stock is up here at 120. Notice inside that little black circle that the difference between the red and the blue curves is minuscule. There's just a few pennies there that you could possibly soak up. And that's going to happen with the passage of time or if the stock happens to push higher. But there's so little there. On the flip side, look what happens if we come down this way. See, think of this as maybe a slide or a snow ski mountain. If you go in this direction, you can go off this steep embankment. You can really start taking losses. If you go this way, you're just going flat because you're at maximum gain. So there's very little incentive to hold this. So this is, again, a fairly simple example of what we would call a danger. If we're in these areas, kind of in the center of the green or in the red, we would call those risks. They are quantifiable. We can figure out probabilities and see if it makes sense to continue holding it. And those are things that we want to manage. This is something that we don't want to manage. Why? Because there's nothing to manage. The best traders in the world cannot manage this. That's why it's called a danger. It cannot possibly help you, but it could certainly hurt you. So again, I mentioned that we're going to look at some examples. We'll do one today and then we'll do one on Monday. But I wanted to show one that is not so obvious. And that is a danger in a strategy that we call a stock replacement. Now, for everybody who is with Market Rebellion is very familiar with stock replacement, fabulous really for any type of trading and even for long-term investing. So the stock replacement strategy, the basic essence of it is you're going to buy a deep in the money option. Usually going to be a call because there's a long-term upward bias. So for a long-term play, it would usually be a call. And we're going to buy it roughly with an 80 to 85 delta. Now, there are exceptions, but that's the general rule. And when you do that, you're going to find that that call option behaves very similar to stock. Not exactly, which is why it's not delta 1. Delta about 85. So you can think of it as being 85% of stock, and it's going to get closer and closer to stock as we get towards expiration. That's assuming it moves in our favor or as time goes by. But if it goes against us, then we will not have these high deltas. But the point is that we get a sharply reduced cost. That's the real benefit of the stock replacement strategy. We have very little extrinsic value, so it's behaving about like shares of stock, but we're just paying a small fraction. And so that means we can spread our money thinner, we have less money at risk, we can diversify it into other strategies, all kinds of benefits just from using this one strategy. So let's say that we have a stock trading for 100 and you buy a 180-day call, 180-day expiration $70 call. Now, I've put these in according to a pricing model. I think I use 30% volatility, but again, it doesn't matter. It's just from a pricing model. The point that I want you to know is that I'm not making these numbers up. I'm keeping them consistent in a pricing model. So according to these parameters in the Black-Scholes, it says that this $70 call is $31.50. So notice that if we pay $31.50 instead of the current stock price of 100, that's about 32%, right? 31.5% to be exact, but it's about a third. And so 2/3 of your money can now either be parked in cash if you wish to average in or scale into a position or diversify it into other strategies, buy protective positions on top of this, all kinds of things that we can do because we're more cash efficient. But now let's say that the stock rises to 110. Certainly moving in our favor, that's a good thing. And according to this pricing model, it says that the $70 call would be worth $40.70. So notice that the call increased $9.20. All right, so it didn't raise the full amount because it's not delta 1, but it picked up a good part of that. So again, you can see that this is a really beneficial position to be in, and yet we have a fraction of the money at work. But I want you to keep an eye on that $40.70 price. It will come back to us in a moment. So right now, just for a recap, we paid $31.50. Stock has moved in our favor. We look at our broker's platform, it's worth $40.70 right now. So this is the risk graph that we have. There's our bend, there's our 70 strike, and the stock is up here. So the question I want to pose to the group is, where's the danger? And people will look and say, hey, this has got to be a trick question because there is no maximum on a long call, right? The first example I showed you was a vertical spread, and I said it's got a maximum payoff of 5. So you're probably thinking, well, there is no maximum payoff here, so it's a trick question. There is no danger here, and this is how many traders see this. And unfortunately, that is absolutely incorrect. There's a very big danger here, but it's hidden. So let's break it down. Here's the benefit that we get from, or at least one of the benefits from the long call or stock replacement, is this bend. Remember, as I mentioned, if the stock moves in our favor, all is good. But if it falls, we eventually get this area of positive gamma, which starts doing what? Reducing the rate at which we lose. That's why we eventually flatten out down here into this hockey stick shape. So that's a benefit. We'd like to keep that. And one of the ways that we show traders how to do this is through it's technically a type of morphing technique, but it's called a roll. And when you roll a position, there's actually lots of rolls, but for a long call option, we're going to sell our current call and replace it with a higher strike. So let's say that we wish to sell our 70 strike and buy the 75. Okay, notice that the line is now shifted up, the red line shifted higher, and the bend occurs at 75, not at 70. But you can also see there's not a very big difference in those curves. We're just not giving up really anything, at least at this point at expiration, in those two options, but we are reducing the amount we could lose. Okay, so that is the real key reason for doing a roll. We want to shift this curve up and get some of that money off the table, but still continue to hold on for the unlimited gains. But now there's a problem. Let's go see if we can dig a little deeper. How do we roll this thing? The $70 call, this is the one that we started with. If we wish to roll it, I would sell the 70 call and I would buy the 75. Now I could do these as two separate trades. I could just place an order to sell the 70, that would cancel this one out, close it. I could place a second order to buy the 75. There's a problem that's called execution risk though, if the stock price moves against us while we're setting up this trade. So whenever possible, we always try to do it as a simultaneous order. I want to sell the 70 and buy the 75 at the same time. So how can I do this in my broker's platform? Notice that is a short vertical spread. And this is why it's hidden. Traders will go, well, I never bought a vertical spread. Well, possibly, but you are selling a vertical spread. Now, it doesn't matter that once this trade is executed, that you're just long the 75. See, notice that your long 70 call over here cancels out against the short 70. Now, when your order hits the floor, the traders don't know that. They don't know that these $70 calls are going to cancel, nor could they care. They're just saying it's a vertical spread. From their perspective, that's all they see. Somebody is buying the vertical or somebody is selling the vertical. They don't know if it's opening or closing. Those are all OCC characteristics in terms that has nothing to do with the trading floors. This is a short vertical spread, period. So now let's take a look at it. If I do the roll by selling a vertical, there's one vertical. If I get lucky enough to do a second roll, I shift up to here, still with a vertical. I do a third, a fourth, I just keep walking up the ladder. So even though that first screenshot that I showed you of that curve shifting up, we're really doing it with vertical spreads. Doesn't look like it, but we are. So the question now is, when should you sell a vertical spread? Well, we just talked about that. What if this thing's trading for $5 or for $4.90? Do you think we should sell it? No reason to hold on to it. Well, that might be an area to go look at once we know that this long call actually has, depending on how we look at it, some vertical spreads embedded into it. So remember that I said the stock is up here at 110. I said, remember that $40.70 price. So here it is. We look at our broker's platform. It says, yes, your $70 call is worth $40.70. What do you want to check as traders? You want to ask about the 70-75 vertical. Now again, don't say, I don't have a 70-75 vertical. Well, sort of, but you have the ability to trade it. You have the ability to sell it. So let's go take a look at it. What's it trading for? That same pricing model tells us that the 70-75 vertical is There's our magic number, 490. What is that? That is a big, fat danger. It cannot help us anymore, but it could certainly cause us to lose. So what should we do? Close it. It's a danger. Get rid of it. So what we want to do is to close the 70-75 vertical. In this case, we're going to get a net credit of 490. That's the current price of that spread. Our cost basis, remember we paid $31.50 for the stock replacement. We received $490. We now have effectively $26.60 into it. And yet we still have unlimited gains, but I've just peeled off a pretty good percentage of the initial cost that I had into this. So here was our initial position with $31.50 cost. There's our short vertical. What happens? I've now rolled from the black to the blue. I have a cost basis of $26.60. I've done almost no change to this side. Notice that this blue curve virtually almost perfectly overlaps the black. There's no reason to not do it. You're giving up 10 cents to the upside. All right, big deal. Technically, if we zoom in, we would see a 10-cent difference. But we're guarding $4.90 of potential losses, and yet we are keeping 100% of those deltas to the upside. All right, so there's our current graph. Everything looks the same. It's just risk management. Okay, so we've retained the manageable risk. That's a key. And what else? We've eliminated the danger. That's probably a bigger key. And one of the key topics I want you to get from here, it's not just about managing all risks. Part of being a risk manager is to be able to identify the dangers and get rid of them. There's nothing you can do with them. The best traders in the world cannot do anything with that. John and Pete cannot do anything with it. I can't do anything. Stu can't do anything. Ryan and Wayne can't do anything. We would all come to the same conclusion. Get rid of it. And yet most of the traders that I talked to would still continue to hang on to that. Why? Because they never knew where to look. And as I always tell traders, it's easy to overlook the things you can't see. And hopefully now you can see that there really are some vertical spreads embedded in that rolling strategy. So the question I would like to pose to everybody right now, are you trying to manage dangers? And probably a better one, are you missing the opportunities? All right, so these are the things that you have to ask yourself. And one way that you can quickly find out is to take advantage of this free, yes, it's free, one-on-one coaching session. You can either just do just kind of a coaching, not necessarily a call, but just more of an assessment. What are you trying to do? They can pass on some tips of things that would help you. Or maybe you've got a specific trade on or trade vertical spreads or whatever and would like to chat about that. But it will open up your eyes to different ways that floor traders and professional traders will see your strategies. And so if this is new to you, whether it was yesterday about the embedded butterflies or today with vertical spreads hiding in a long stock replacement position that you're planning to roll, or on Monday, we'll take a look at how they can even hide within vertical spreads. So I showed you one way where they can hide in a vertical spread, but they can also hide within a vertical spread. And this is where things become absolutely fascinating. So please, take advantage of it, no risk. The phone number there is 888-809-8058. And so give them a call, set up your free coaching schedule, and just see what a difference it can make.